fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. Gold, TLT, and my gold stock are flashing this dangerous macro nightmare ahead signal. While the Fed and Wall Street are still debating how many rate cuts they are going to do this year. The U.S. Treasury is expected to borrow a net $202 billion from April to June. I guess it's the tax season. In this video, I will explain 2 reasons why I believe we are going to have a correction from April to June. Why is gold and my gold stock keeps on going higher while the stock market is finally going to have a long-awaited correction till June? Or is there a deeper explanation? I will also tell you why March was an unexpectedly strong month for the S&P 500. Global liquidity is losing momentum, and April could prove a trough month as the U.S. tax-paying season kicks off and drains money markets. Even Bitcoin is also taking a chill pill. What's going on? To find out, let's go back and look at what happened to gold. On the 1st of October 2007, gold broke out to all-time highs for the first time in a year and a half. From that moment on, the unemployment rate in the United States began to rise aggressively. Economic growth began to slow down, and ultimately it led to the global financial crisis later in 2008. In 1972, gold prices surged by 60% right before the United States witnessed a destructive second wave of inflation, where headline CPI reached a staggering 12%. In fact, gold did the same thing in June of 1978, breaching past its previous all-time high from 4 years before, signaling that the United States was about to experience another wave of inflation, where CPI this time reached a staggering 15%. Gold is breaking out to new highs today, breaking above a resistance that is marked by gold's top in 2011, 13 years ago, and in August of 2020. As we've just seen throughout history, gold breaking out to new all-time highs is typically not a good sign for the U.S. economy. In the 1970s, it signaled that inflation was about to come roaring back, and in 2007, it signaled that an economic downturn was not far off. So today we need to take a serious look at what this message breakout in gold is sending us, and whether we should be buying this breakout to protect ourselves as investors. For risk-off market, investors need to choose between owning debt, like Treasury bonds TLT, or cash, like 1-month Treasury T-bills, or owning gold that basically just stores value no matter what's the situation. They're going to choose debt when interest rates are high enough to compensate for inflation. Let's say tomorrow the 10-year yield is paying us 10%. Now it is still sitting at 4.3%, by the way. So 10% for 10 years, that's better than the stock market. While the inflation is at 3 to 4%, then I will buy the IEF or TLT, because inflation will be dead if the Fed raises the Fed funds rate to 10% instead of 5.3% today. Then we will have a recession very fast. You know, Warren Buffett doesn't play this game. He likes to buy 1 to 3 month T-bills, which is cash equivalent, and owning oil stock. If 10-year yield is at 10%, oil price might be at the moon already, if you can imagine that. When central banks and institutions are choosing gold, this is a very serious macroeconomic nightmare. Is about to happen historically.
The United States can pay any debt it has because we can always print money to do that. So there is zero probability of default.
It's a Treasury bond world. The stock market just lives in it. What's really going on is the U.S. Treasury Department reduced its estimate for federal borrowing for the last quarter despite a widening in the fiscal deficit, a reduction unexpected by many dealers. The Treasury Department cut its net borrowing estimate for January through March to $760 billion from a previous prediction of $816 billion released in late October. The smaller borrowing need was driven by higher projected net fiscal flows and having more cash on hand at the start of the quarter than expected. The department said in a statement, what's happening is during the first quarter, the Treasury borrowed less than expected. This is the key. Now that we are in the second quarter, because the first quarter, for some reason, they borrowed less. That backdrop has most dealers expecting the Treasury to announce a final round of increases to note and bond sales at its so-called quarterly refunding, essentially to borrow more money by issuing short-term T-bill or long-term T-bond like TLT. The more they borrow, higher Treasury issuance can lead to an increase in bond yields. The yield on government debt. Rising yields can make bonds more attractive relative to stocks, which is why I always say TLT tends to drag tech stock down with it. Because as bond yields rise, the risk-free rate of return goes up, making bonds more desirable compared to stocks. For the April to June quarter, which is right now, the Treasury on Monday said it expects to borrow a net $202 billion, but that number can change depending on what's happening in the U.S. economy. Dealers warn that there's much more uncertainty regarding financing estimates for the second quarter. Along with the Fed's plans for its quantitative tightening program, another unknown as prospects for Congress enacting a $78 billion tax bill, which would worsen the deficit. Now the market is expecting she will borrow more from April to June, a lot more than $202 billion, which is why bond yields can rise sharply higher. The reason why TLT hasn't fallen too much too fast is because the street is talking about rate cuts that people want to own long bonds. However, I have said on this channel before, it's unwise to predict, let alone trade, where TLT is heading. It's much safer just to own gold or gold stock. That is why I bought my gold stock a month ago when I found out Drunken Miller bought the same Barrick gold stock. I am up over 18% on that position. Not a lot, but compared to TLT, which is down, I am pretty glad I chose gold stock because even though the Fed and Wall Street is talking about rate cuts, they are completely misleading investors because looking at oil price, gold and silver, copper price, coffee price, and even cocoa chocolate price, we have an inflation problem. Like I said 2 weeks ago, second wave of inflation is coming back. This is when TLT will go back down. What's shocking to me is previously when TLT went down, it meant oil price going higher. So the gold mining stock will go down because obviously it takes oil or energy to mine gold. But today, because gold price has kept on making new highs, gold stock are starting to rally finally, because their profit margin has risen significantly. So what does this gold price breakout mean? Where the gold breakout that we're seeing today is telling us that the economy is going to continue weakening. I think, unfortunately, that's what's happening right now. Gold is telling us that inflation is stubborn, but the economy is going to be weakening. Gold is currently breaking out above a huge resistance level that it's been struggling with over the last 4 years. And it's finally now breaking out above it with a very first weekly close above the trend line. If this breakout holds, gold could quickly make its way up towards my target of $2,700. And this cup and handle pattern that you see here suggests that gold is only just beginning a brand new bull market today. Unfortunately, that would spell trouble for the economy or suggest that inflation is making a comeback. I guess that's why Warren Buffett loves his forever Oxy stock. For a forever inflation hedge, before the financial crisis, both gold and oil was rallying together too. But gold keeps on rallying after 2009 all the way till 2011. But oil got wrecked in 2009. So like I said before, it's only making sense to buy oil when we have a recession. The Fed and Wall Street love to mess you up. Markets always do the opposite of expectation. In terms of March, historically, it's a negative month for the market. Think about March 2020 as retail gets sucked into Bitcoin happening at April 15th. Narrative thinking it's bullish. My expectation is Bitcoin is sell the news event. It's really all about managing our emotion when we are buying the dips. I'm hoping I am being more patient as time goes on. I am not going to guess how many rate cuts we are going to have this year. All I am considering is if I see my price target hit, I will take advantage and buy the dang stock at that dip.
When you have too much debt leads to the printing of money to make it easier to service. So all of those things mean that some portion should be in gold.
Warren Buffett won't touch gold.
Mm-hmm. Okay, yeah.
You think he's wrong? Well, clearly you must.
I think he's making a big mistake. Yeah. Gold is like cash. It's an alternative version of cash. So over long term, it's not the best investment. Over long term, it's a little bit better than cash over long term. It is however, when you're having a monetary crisis, when you have a fiat monetary system, and you have the need for money, debt is a promise to deliver money.
Right.
So if you look at each of those devaluations that have taken place, March 1933, President Roosevelt closes the banks and then opens them and says you can get your money. And then they broke the link with gold. And so the history over that period of time is that money can be produced. Gold is somewhat limited. It's an effective, it's an alternative that should be part of everybody's portfolio, but not in a big way.
Incidentally, they're right to be afraid of paper money. I mean, they have their basic premise that paper money around the world is going to get worth less and less and less over time is absolutely correct. But
you just disagree with the investment theory beyond that.
Yeah. Where they run from that, and they should run from it, is where, in my view, they make the mistake. But they have a correct basic premise.
Sows an acre of land, sows a piece of Coca-Cola, sows See's candy. See's candy. If the dollar goes down 50%, we will be selling See's candy for double the present price. We'll be getting the same real price for See's candy. People will work the same number of minutes or hours per week in order to buy a pound or a 2-pound box of the candy. So we would much prefer.
When there are a lot of obligations like that, a lot of debt, or even unfunded obligations like pension obligations or healthcare obligations that the world has, a lot of obligations, and there's not an effective monetary policy to lower interest rates and stimulate, as we're talking about, there needs to be the printing of money, the running larger deficits. We're going to come into an environment, I think, in which there are going to be larger deficits that are increasingly monetized. And in that kind of an environment, the currencies are depreciated. That's an easy way to get out of paying your IOUs.
So just to be clear, you're expecting
money.
Things to take a turn for the worst?
I think that in an evolutionary way, over the next 1, 2, and 3 years, that there will be a turn for the worse. Yes, I think that there'll be an environment in which you're going to have excess capacity and debt restructurings and political issues entering into it. I think the elections that we're going to have in the United States will have an important bearing.